All right, well, hello everybody. We are about to do a video on cash flow statements. So hopefully you've had a little experience with them. If not, hopefully what I do with you today will make a lot of sense. But we're going to go through and show you how to do one of these statements. If you have access to basically an income statement, be great if you had a retained earnings statement, but you definitely need an income statement and a balance sheet. So you need those two particular documents to really have some success with doing one of these statements. Now, what's really interesting about the cash flow statement, it's the only financial statement that you do that you actually already know the answer to before you even start it. So you're probably saying, so why do we do it? Well, if you're trying to figure out how much, like your cash started with, let's say, $100,000 at the beginning of the year, and at the end of the year, it only had 80. So it went down by 20. So we already know it went down by 20. We're just trying to figure out why it went down by 20. So what caused it to go down? Maybe there were parts that caused our cash to go up, and then other things that made it go down overall. So the purpose of the cash flow statement is to kind of figure out why it went down or why it went up, and to kind of attribute it to different types of categories. Okay, so I'm gonna get my video off, and let's go ahead and take a look at the document that I have. Hopefully you can see that the statement over to the left, you see a blank statement of cash flows. The name of the company I created was Cuckoo, right, because we're a little cuckoo to be able to be doing this. But the Cuckoo Corporation statement of cash flows for the year ended December 31st, 2020. But over to the right, I have some notes for you. All right, so you definitely want to copy these down or take a picture of it, or however you want to do it. But you definitely, or print this out. In fact, that's really what I would recommend is, pause this recording right now and then go print out this document so that you can do the statement and have the notes by your side. Okay, so why don't you go ahead and do that now? Okay, so hopefully you have the printout and you can follow along step by step with what I do here. But over to the right, let's take a look at these notes. There are two different types of cash flow statements that exist, the direct method and the indirect method. The indirect method is what is preferred by accountants everywhere, even though the direct method actually follows GAAP. But nobody does the direct method. So what you're going to learn is the indirect method. And again, I didn't think your textbook did a very good job of explaining this, so I wanted to make sure I did one with you. So there are three categories of cash flow statements. The first one is cash flow from operating activities, and there's a certain format that you want to follow. And if you follow this to the T, you should be able to get this section right every single time. I find that this first section is the easiest of the bunch. Section number 2, cash flow from investing activities. I like to kind of apply common sense to number 2 and number 3. So, and the third one is financing activities. So if you can kind of use some common sense as you're doing it, it may make sense why cash went up or why it went down. So before I continue with this, I just want to click on another folder that I have here to the left. And you'll notice that I already have an income statement already done. Here's the Cuckoo Corporation. You'll see the sales of $2 million, cost of goods sold $1.5 million, gross profit $500,000, all the way down to earnings per share. Probably more information than we actually need, okay? But there's a few things that are pretty critical, right? For example, EAT. These are the earnings after taxes. That's like your net income, okay? So it's your net income after tax. So that we need to know. Another piece of information that we're going to need is our depreciation expense. So just to kind of highlight a couple of things right off the bat, those two that I have in yellow are critical. If I scroll down a little bit, you see your retained earnings statement. Started with 250, we added our net income, went up to 350, took out the dividends, and we ended up with 300. That 300 is what ends up in the balance sheet representing retained earnings. Okay. When you have to do one of these cash flow statements, you need the current year's income statement, you need the current year's balance sheet, but you also need last year's balance sheet. So we need 2 years worth of balance sheets to do a cash flow statement. So take a look real quick here. Notice that at the end of last year we had $30,000 in cash. At the end of this year we had $40,000. So that means cash went up by 10. So we already know the answer, but we're trying to figure out why it went up by 10. So there's different things that we have to look at to help us do the cash flow statement. So that's kind of like where your brain should go, right? The first thing you need to know is how much did cash change by. So that's key, right? And then you want to be able to pluck things out of these documents and be able to work with them, all right? So let's go back to this one. And notice this one says operating activities, cash flow from operating activities. Here's some information you need to pull from the income statement. So notice it says start with net income, or EAT. So if we go back to that other chart where we had the income statement, here's our net income, or EAT. Remember the one I had here in yellow? So we're going to start every cash flow statement under the operating activities section with EAT. In fact, that's how you know you're using the indirect method. So if you went online right now and looked up some publicly traded companies' financial statements and you looked at their cash flow statement, the first thing you see under operating activities is net income, or EAT as they call it. You know they're using the indirect method. So let's go ahead and start that. I think I'm here at the left margin. So we're going to start off by saying cash flow from operating activities. And then underneath cash flow from operating activities, we're going to write net income, or otherwise known as EAT, earnings after taxes. Okay, so that amount was $110,500. 110.5. If you're wondering how did I get that, again, came from here. So you're looking for the EAT, or net income after tax. Okay, so earnings is the same way of saying net income. So net income after taxes, or your EAT, 110,500. So that's where that 110,500 came from. So let's go back to our little notes. So it says start with net income, or EAT, under this operating activities section. And then it says also from the income statement, we want to add back any depreciation expense. So that's why I highlighted this one earlier. So we want to add, so if your income statement has depreciation expense, and it better, I don't know of any any income statement that doesn't have that, because everybody typically needs some type of equipment to operate, but there's exceptions, of course. So depreciation expense, normally that's being subtracted from the income statement. That is a non-cash flow expense, so we're going to add that back. So we're going to add our depreciation expense. So even if you're not sure why, just follow the rule. So we're going to add that depreciation expense of $50,000. Let me put this in accounting mode before I forget. Just hit the comma. So now that they all line up. Okay. So the next thing I want to do is, again, follow the rules. I want to add any losses. I want to subtract any gains. And I would find that information in the income statement and typically at the bottom of the income statement. I do not see any losses. If I had them, I would add them back. If I had any gains, I would subtract them from the cash flow statement. So all we had was the net income and the depreciation expense. We did not have any losses. We did not have any gains. So let's move on. So now it says, from the balance sheet, let's analyze all the current assets except for cash. So let me go back to here and let's take a look at our current assets. Here's the current assets, and it wants us to analyze them all except for cash, because ultimately we know cash changed by 10 and we're trying to figure out why it changed by 10. So we're going to be looking at these current assets: marketable securities, accounts receivable, inventory, and prepaid assets. Okay, prepaid assets would be like prepaid insurance, prepaid rent, stuff like that. So marketable securities, no change. So we won't even have to worry about that because there was no effect. It was a wash basically. But notice that your accounts receivable went up. Notice that your inventory went up. Notice that your prepaid assets went down. I highlight up and down because take a look at the instructions. From the balance sheet, analyze all the current assets except for cash. If a current asset went up, we will subtract the difference. Subtract the difference. If the current asset went down, we will add the difference. So think about it. If something goes up, we're going to subtract. If something went down, we're going to add. So it's like we got to think opposites. Because normally when you think something went up, you add, right? But here, if something went up, you're going to subtract. If something went down, you're going to add. So think opposite of normal thinking in this section right here. All right. So again, if a current asset went up, so accounts receivable went from 170 up to 200. So that qualifies as going up. So it went up by 30. So this says if the current asset went up, we will subtract that 30. So we're going to write here, subtract the increase in accounts receivable. And that was $30,000. Put that in red so we know we're going to subtract it. So accounts receivable went up. It went up by 30, so we're going to subtract that 30. We also had inventory that went up from 160 to 180, so that went up by 20. So if it went up, we're also going to subtract that. So subtract the increase in inventory So again, we're working opposite of what you would think you would do. Okay, let's see. We had one more current asset, and that was the prepaid assets. So it went from 30 down to 20. So it went down by 10,000. If we're working opposite, something that goes down, we add. So we're going to add the decrease in prepaid assets. So I just follow the rule. I don't even need to know what they are or what it even means. As long as I follow the rule, I can kind of make my way through this maze. So just follow the instructions. So we first grabbed information from the income statement, right? Now we're grabbing stuff from the balance sheet. So we analyzed all the current assets except for cash. And now we are analyzing, about to analyze the current liabilities as well. Okay. So here are the results. This came from the income statement. This one came from the income statement. These three came from the current assets section of the balance sheet. So let's keep going with the notes. From the balance sheet, analyze all of the current liabilities. If a current liability went up, we will add. If a current liability went down, we will subtract. Oh, that sounds normal now. So now we're going to think normal. It's no longer opposite. So we only had that opposite thinking in the current assets section of the balance sheet. So now we're thinking normal. If something goes up, you add. If something goes down, you subtract. It was only earlier that we had to do the opposite. So let's go look at the current liabilities. Yes, I'm skipping these other assets because I'm following the rules. So now I'm going to my current liabilities and I see accounts payable, notes payable, and accrued payables. So it looks like our accounts payable went from 45 up to 80. It went up by $35,000. So if it went up, we're going to think normal. We're going to add. So add your increase in accounts payable. And that was for $35,000. The next current liability was notes payable. It was 100, ended with 100. It's a wash. We can just ignore that. Accrued payables, that would be like wages payable, as an example, interest payable. It went from 35 down to 30. So we had a decrease of $5,000. So that means we are going to subtract. Okay, so I've exhausted all of the rules that are associated with operating activities. So now let's add our results together. So in the second column, I want to add and subtract all these numbers from each other. Whoops, I accidentally did that wrong. Let's try it again. Equals there we go. And I get 150,500. And I'm going to call this my net cash flow from operating activities. Okay, so notice I've got 150,500 positive. If you remember, our cash flow went from 30 up to 40. So it went up by 10. So far, I have it going up by 150 and 500, 150,500. So there's still a lot more to go. I need to end up with just 10,000 as my answer. So let's go to the next category, which is investing activities. So this is my cash flow from investing activities. Okay, so I like colors, so let's put this one in, and then we'll do that one in the same heading color. Okay. So now cash flow from investing activities. So let's look at the instructions. Investing activities deals with investments and long-term assets. Use common sense. If cash is paid, remember this is a cash flow statement. We're trying to track what happened to cash. So if we bought equipment and paid cash, our cash goes down. If we sold the equipment and we got cash in the sale, our cash goes up. That's what I mean about using common sense. So let's look at our investments and long-term assets. So here's our investments. And it looks like at the beginning of the year, we had $20,000 worth of equipment. At the end of the year, we had $50,000 worth of equipment. Well, it looks like we bought more equipment. Well, I don't know about you. When I buy something, it costs me money. So that's an example of my cash going down, right? Because I had $20,000 worth of stuff. I now have $50,000 worth of stuff. I must have gone out and bought more stuff, and that costs money. So under cash flow from investing activities, I'm going to subtract my increase in investments. So you're assuming you spent money on this stuff. So if you have more stuff, you spent money, so your cash goes down. What about plant and equipment? So I had $1 million worth of plant and equipment. Now I have $1.1 million. That means I bought more stuff. If I bought more stuff, I needed more cash. So I will do the same thing. Subtract my increase in plant and equipment. It took me forever to find the ampersand. What the heck? There were no other investing types of things. So I can conclude this section. So my net cash flow from investing activities, $130,000 negative. Remember, I'm supposed to be up 10. So right now I'm up 20,500. Right? I got a positive 150 from the first category. I got a negative 130 from the second category. My third category, assuming I did the first two correct, has to go down by 10.5, right? Because I need to end up with a $10,000 final result. So let's go to this final category, and that's cash flow from financing activities. Can't spell to save my life either here. So let's see what it says for financing activities. Again, it says use common sense. So issuance of stock. If you issue stock, you're bringing money into the business, right? So like if people pay you money to be owners, your cash goes up. If you had to pay dividends, your cash goes down. If you are borrowing money for bonds, then your cash goes up. If you're paying off a bond, your cash went down. So again, what did you do? How does it affect your cash? So let's see what kind of activity we had associated with. Did we have any issuance of stock? Did we have any bond stuff, any loans, any dividends? So let's see what happens here. So if I notice, I do have some bonds. All right, so looking at my long-term liabilities, my bonds went from $40,000. So I owed 40. Now I owe 90. So think about that. If I go to the bank, pretend this is not a bond, it's just a note. If you go to the bank and borrow money, I owed the bank 40, now I owe them 90. That means I must have borrowed 50. That means my cash went up because I now owe more. So I'm going to add my increase in bonds payable. Basically, I borrowed $50,000 from the bank or from the bond market. Okay. So that would be an example of long-term debt. Did we have any other long-term debt? No, that was it. Let's take a look at the stock situation. Preferred stock, no change. Common stock, no change. But retained earnings, there was a change there. All right. So my retained earnings went from 250 up to 300. So I got about a $50,000 change there. So I gotta kind of figure out what happened. All right. So this is where my income statement and my retained earnings statement can come into play here. And what I'm referring to is this last little information here, which is dividends. Were there any dividends? So if I look in the income statement, were there any dividends? I do see some dividends, 10.5. So if the company paid out dividends, that means the company lost cash, right? So paid preferred dividends, and the amount was 10.5. So let's look at that again. There's the 10.5, preferred stock dividends. But in the statement of retained earnings, there was more dividends, another $50,000 worth of dividends. Okay, so that means those were common dividends paid. $50,000. Okay, so let's see what we got here. Let's see if this gives us that magic number. Alrighty, here we go. And 5, negative. So my operating activities came out positive, 150. By the way, it's okay if investing ends up negative. It's okay if financing ever ends up negative. But if your operating activity section ever ends up negative, your company's in trouble. This number should always be positive. This one could be positive or negative. This could be positive or negative. But the first one must always be positive. But let's see if we really did this right. This, take away the 130, take away the 10.5. We're hoping, we're praying that it's 10,000, and sure enough, it is. So that's where our 10,000 went to. So the net change in cash flow was $10,000. Okay, if you want, you can even do this. Add the beginning cash of 30, and that'll give us our ending cash of 40. And that's how you do a cash flow statement. And let's clean it up a little bit. Double lines. We need the first number in each column gets a $, and final answer gets a $. And that's your cash flow statement. Okay? Alrighty, so that's it. So I hope this was helpful, at least gives you some idea on how to do a cash flow statement. They can be a lot more complicated than this, so on a scale of easy, medium, and hard, this is probably somewhere between easy and medium. Okay? Alright, you guys, have a great day, and we'll see you next time. Bye-bye.